Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
We reduced their total fees in writing, direct and indirect, down to 1.4. So over the next 20 years, she's projected to save over $320,000 in fees.
You better look at your time frame. You know, you have 15, 20 years, you have to preserve those assets. And forget about what your stockbroker told you. You know in your gut you're not getting a 12% annual compounded rate of return on your money, or your money would have doubled every 6 years, and it didn't happen.
What about when someone says, put your money in the stock market for inflation fighter, and the stock market crashes? What chance do they have of keeping pace with inflation?
Well, forget about that.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. Make yourselves very comfortable because the show starts right now.
Hi, and welcome to this week's Author's Corner. As usual, I'm here with Dan and Jim. They are TV personalities, radio talk show hosts, and best-selling authors on Amazon.com. Guys, we have a great topic today, and it's, can you handle the truth? And my first one I'll send to you, Jim, and it's, retired now, should I invest aggressively, or should I invest for principal preservation and income?
Kind of depends on your personality. You want to go through life being anxietal, full of anxiety, then invest aggressively, right? That doesn't mean you can't take a little bit of your portfolio and invest aggressively, but if you're retired, which this person is, you need to make sure that you are preserving those assets that took you 40 years to save, because you're going to have to use those assets for income. And using assets for income means you're going to draw down your portfolio, which means that if you're aggressive and you lose 30, 40, or 50% of your money in a stock market crash, and you're drawing down your portfolio through income, you're going to have a lot of anxiety. So you better change the game up.
Jim, let me ask you as a follow-up, because I'm sure a certain percentage of the folks that you see in your office, whether they're a couple or individual, they're DIY investors, and maybe they've done a pretty fair job. What would you say, what percentage of those folks are DIY investors, do-it-yourselfers?
I don't know. I guess, maybe 30 to 40% of the people that come in. Yeah, I mean, they at least at some point in their life, they've done it themselves. But as you get closer to retirement, I do believe you need a different skill set. Whether you work with our firm or another planning firm, that's up to the consumer. But you have to go with a firm that actually specializes in pre-retirees or retired people, because the assets you use, the strategies you should implement, the techniques that are used are different if you want to preserve the asset.
The big reason is last year in 2022, for example, the stock market had some big losses. So DIYs, do-it-yourselfers, they lost a lot of money. They don't want that to happen anymore. They are looking for help at a professional level so that doesn't happen to them again.
Yeah, and they might have been great, Dan, at accumulating all that money, but now we're entering a different stage, right?
Definitely.
And it requires, just like you said, a specialist, totally different skill set.
Definitely, because to accumulate assets, you really have to take risk. You have to be willing to suffer losses. You have to look at it for the long term, knowing you're not using your assets for 10, 20, 30 years in the future, which you can do that. And then people that stay the course can probably do okay over that time period. It works. The problem is once you get to within 5 years of retirement or in retirement, you can't have that same mentality. You have to switch over to a more conservative methodology, which is asset preservation. Make sure you don't suffer big losses and create income off of that asset base that's guaranteed to last for as long as you live, or at least has a extremely high probability that it won't run out for as long as you live.
It doesn't mean you don't have growth in your portfolio, because you will have growth in your portfolio. We're still going to invest assets in the market, but we're going to use different strategies to do that to control the risk. We're going to run stop loss technology, and we have other assets that have no market risk that produce income. So it's an integration of a number of concepts and strategies into a plan that's going to work for a retired person.
Yeah, let's talk about a strategy that we know is rather popular, okay, and that's that 60-40 model, if you will, where it's part stocks, it's part bonds. Are they safe in that model? Or is this going to be a good model to create income? Is this a good model for preserving assets?
Retirees and soon-to-be retires have been told a 60-40 portfolio, which is 60% stocks or stock mutual funds, 40% bonds or bond mutual funds, is safe. The problem is, we don't think it is just based on what has happened to those portfolios. And if you're age 60, they tell you that's the portfolio you should have, 60% stock, 40% bonds. Well, if you had that portfolio in 2022, you probably were down between 20 and 25%, even though you were supposedly safe. Well, 20 to 25% in our definition is not safe. That's moderate to almost aggressive, because the market went down, if you look at the S&P, about 20%. The NASDAQ went down about 33%. Bonds went down significantly. And if you lose that much, you're not in a conservative mode. So you have to rethink nowadays what that traditional portfolio model is and look at other alternatives that can reduce your risk and give you income that's not going to run out.
Yeah, Jim, and to go one step further, I think that at times, not only is there a 60-40, but they are potentially being told by their broker, hey, the history of the stock market is an 8, 10, 12% return. You're going to be fine.
Well, if you go back to 1929, that's fine, but you're not going to live 100 years in retirement. You better look at your time frame. You know, you have 15, 20 years, you have to preserve those assets. And forget about what your stockbroker told you. You know in your gut you're not getting a 12% annual compounded rate of return on your money, or your money would have doubled every 6 years, and it didn't happen. So you have to understand that, hey, there are different strategies to be used right now. There's different skill sets offered by advisors. You have to select an advisor that specializes in retired people, because the strategies are different.
Well, you look at just the numbers, Mark, and it goes down to, since 2000 to 2022, the stock market, based on the S&P 500 index, has increased by 4.28% per year compounded. Not a really big gain, and you would have had to suffer 2 losses over 50% during that same time period. How in the heck does that make any sense? 2 losses over 50%, and now you net about a 4.28% gross before fee, before income, before tax rate of return of the S&P 500 index. Doesn't make a lot of sense.
Dan, Jim, thanks so much. Hey, if you want more information about anything we talked about here today, pick up the phone. Let's start a conversation. 916-452-7325, or go to our website. And don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
On this week's segment of We Fix Your Money, you're going to meet Luann. She's age 70 and recently divorced. She's really scared about making financial mistakes like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they helped Luann.
Thanks, Mark. We're very excited to be here presenting this week's hypothetical case study. And when you look at Luann, she could be like a lot of retirees, maybe just like you, age 70 and single. Could be from a divorce, could be from a death in the family, could be that you've never been married, but either way, you might be having to plan everything by yourself, which is scary. In this example, we're looking at her having $1.85 million of assets, total assets. She was a teacher. She gets $50,000 a year as a pension. Her ex-husband had always handled the money as far as the investment. She did the budget, so now she has to handle both of these. She has no debts, and she is definitely ultra-conservative like a lot of our clients, but she wants an actual plan in writing, because that's the only way she feels that she can stop worrying about her money, is having everything in writing and being able to understand it. And she doesn't want to continue to worry about how much risk she has and suffering big losses. She hates that thought. In fact, it makes her not be able to sleep very well at night. She doesn't want to worry about her money ever running out, because she knows she has a high probability of having a long lifespan, and she wants her money to last forever so she can continue to live at her standard of living. And she doesn't like the thought of not understanding her money, because she hasn't up to this point. She wants someone to teach her and make her feel comfortable that she can understand the money. And she does have one son, and she is very, very adamant that she does want to leave a decent legacy for him once she's gone. So this is kind of typical type of planning we do for someone that's single and that is really focused on having a secure retirement.
You know, Dan, we happen to deal with a lot of single people, as you mentioned, whether divorced or somebody's deceased, and they're on their own. They're frightened. They don't know what to do, and they're left with this task of making sure they position the money correctly so they'll have it for the rest of their lives. We did an allocation and risk assessment for her plan. In her current plan, she had $120,000 in the bank, She had $1.7 million plus in growth assets, that's in the market. She had no money in the principal protection and lifetime income bucket. We increased her bank funds significantly to $250,000. We thought as a single person she needed more money to bank in CDs, which were going to earn an interest rate. We lowered her growth bucket down to $800,000 because it had too much risk in it and we wanted to increase the income. We put $800,000 of her assets in the guaranteed principal and lifetime income bucket, same amount of money. And when we did the risk assessment for her, she had a 37.9% risk factor, which means that the market drops by 50%. She proposed to lose about 38% of her money, which really scared her significantly because she's on her own. That means she would have lost about $700,000 if the market crashed like it's done in the past several times. And she would need a 61% gain to make up that 37.9% loss. Again, we just reshuffled the cards. We lowered her risk to 5.3%. Rather than having a 38% risk factor, she had a 5% risk factor. And rather than losing $700,000 in the market crash, she was proposed to lose approximately $98,000. And the key here is that we only need a 5.6% rate of return to make up that 5.3% loss, not a 60% rate of return, which she would need where she was currently at, Dan.
Well, think about it. If you're single, can you imagine having a 37.9% risk factor and potentially facing a $700,000 loss by yourself? How are you going to make that back up? We have to get that risk level down close to that 5% risk factor, and then we still have some risk of loss, like Jim, you pointed out, $98,000, but we only need a 5.6% gain to recover. We can do that, and what this allocation allows us to do is to design the proper income plan. So if you look at her income assessment, her current assets were providing zero amount of income to her, and that wasn't going to allow her to do what she needed to do at retirement time. So now we're going to generate an estimated $67,000 of income just from her assets, with $43,000 of that, 2/3 being on a guaranteed lifetime basis, and we used about $800,000 to create that. So it was a perfect allocation for her to do exactly what she wanted to do with her money to achieve her goals. Her current fees were about 2.27%, so we reduced them a little bit. We reduced her total fees in writing, direct and indirect, down to 1.4. So over the next 20 years, she's projected to save over $320,000 in fees, which means there's either more income in her pocket or more assets left later down the road because she's not paying as much to her advisor. So when you do this, then it actually allows us to complete the full income and net excess monthly spendable analysis, Jim.
Yeah, Dan just mentioned we got the risk down, we got the fees down. Now it's about income. So we generated almost $15,000 of gross monthly income. Taxes were going to be about $3,200. That's federal and state tax. Net after-tax money, $11,603. She had a budget of $7,500, which included all of her travel expenses, all of her entertainment, her mortgage expense, etc. We were able to generate $4,100 every single month in excess cash flow above her budget, which was an extra $49,000 a year of extra money she could do things with, and things that come up in life, right? And she wanted to be able, she could manage through inflation. What about long-term care costs? All this excess cash flow allows you to do that.
And it's perfect because then that allowed us to say, guess what, Luann, you're going to be fine. Everything's going to work out. And rather than just saying it, we put it all in writing so she can see it and then feel it. But then she immediately wanted to know, okay, how much can I leave to my son? So let's assume her portfolio assets earn about 4% per year, her bank earns 1%, and her real estate appreciates at 1.5%. And let's assume she has a great retirement. She spends all that income we were giving her. She never saves one penny. Well, that means by age 90, she would have taken out $1.52 million of income, and she spent it all. Then by age 90, if her assets just earn 4% in the portfolio, her bank earns 1%, and her real estate earns 1.5%, she's projected to be able to leave $4 million to her son. Even though she took out $1.5 million and spent it, there's still is a projected $4 million left that she can leave to her son, which was one of her goals. So Jim, maybe give us a good summary of what happened to Luann.
There's no way you can accomplish this in investing money. You have to have a full written plan in place, which we did for this lady along with every single client. She now is secure, she's single, she has to rely only on herself. We reduced her risk, we reduced her fees. Money will last now for the rest of her life. It gives her significant comfort. She has a better money IQ. She actually understands her money because we took her through this educational process. She's able to leave potentially substantial sums to her son. And guess what? She, like all of our clients, are going to worry a lot less about their retirement.
And you have to figure, most people want to feel this way. They want to feel what was accomplished for Luann in this case study, and you can accomplish these same things based on what your goals are, and it'll make you feel so much better that retirement will work, and it'll work successfully for you. So Luann had a great retirement. We want you to have the same. Mark, back to you.
Wow, guys, what great results from a great plan. Your situation may not be exactly like Luann. You may be married or still working, but you can see how planning can help you attain your goals and alleviate some of your worries about money. If this is something you'd like help with, give us a call right now. Pick up the phone 916-452-7325 or visit our website. Now stay tuned for a great complimentary offer.
Hi, I'm Dan Ahmed, president of Peak Financial. We have a great free offer for you. We're offering you a free, worry-free retirement roadmap that includes a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all for free. No pressure, no obligation, guaranteed. Call the phone number on the screen or go to our website to claim your free offer. You have nothing to lose, there's no risk, and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, great to be back for this week's Peak Financial Freedom radio show, and we're going to talk about some questions we've been asked in the past, and these are questions of people that are either retired or getting ready to retire, and we think these types of questions are great for the current listeners because we think a lot of these questions are being answered or being asked right now by the same people listening, right? Because
exactly.
It's going to fit them if you're retired or getting ready to retire. So how about Judy? Judy's 66, wants to retire, but she doesn't have a pension, so many people don't. I remember losing 50% in 2000, recovering by 2007, losing 50% again in 2008, then recovering by 2015. I'm an engineer, and I have been able to calculate that I have earned an annual compounded rate of return of 3% since 2000. Two questions. Do you think my math is correct, and what can I do with my current 401k to plan for a secure retirement?
Well, first of all, she's right on, because from 2000 to 2022, the S&P 500 before fees and taxes, before you took income out, earned about 4.26%. So she's right on, because if she paid fees and paid taxes, she's probably at 3%. But Dan, most people don't understand that.
Well, what happened to that 12% stock market rate of return?
They got it between 2009 and 2020 maybe.
After the drop.
After the drop, but you have to take in a full cycle, business cycle of 15 or 20 years, and she's right on with that. So that, what you have to do when you actually understand the math, what she does is you have to say, okay, how do I design a plan to maximize my income retirement, reduce my losses, reduce my fees, and make sure I don't run out of money? And that's exactly what she can do, Dan.
Definitely. Well, and Judy, she's 66, and apparently I'm guessing that a big chunk of her money is probably in 401ks. She's saved it, she's deferred it, and she thinks she has to leave it there, and she doesn't. If she's 59 and a half or older, she has the right to use what's called an in-service withdrawal, and it's not that you take a withdrawal and pay tax, but you can actually take your 401k money and you can transfer that into an IRA and then invest those dollars any way you want that's an acceptable IRA investment. We can design a portfolio using what we call our three-bucket scenario, where we have some money of that portfolio in cash, some money in the market, and some money in the principal protected and guaranteed income, and really put Judy in a position where she doesn't have to worry about the money any longer, try to get competitive rates of return without taking excessive risk, and really give her a plan in writing so she knows where income's going to come from, what her taxes are going to be, her fees or risk, all those things make her feel a lot more comfortable. How about Leon and Sally? They're both 65, retired. They say they're in great health and they have longevity in both their families. We want to create dependable income that can increase over time because of how long we may live, to fight inflation, I guess. We like the idea of annuities paying guaranteed lifetime income, but every annuity we've looked at pays a flat level income without increases, which we love the guarantee, but we don't like that it's not going to increase. How can we possibly keep pace with inflation and still have dependable income? Well, I think this comes down to just knowing the market and what's available in there and being income planners. And that's what we are. We're risk and income planners. We can use exactly what Leon and Sally are asking. They're asking for something that will give them income guaranteed for as long as they live, but with the potential for increases over time. And we deal with those types of annuities. The increases aren't guaranteed, but if you do get gains inside of your contracts, you can actually increase your income by the gain. So let's say you're getting $50,000 a year of income, and you get a 5% gain in your contract, you would actually have the potential to get a 5% raise on your income that would go up to $52,500, and that income is guaranteed and locked in for the rest of your life. And once you get a raise, it never goes back down. So imagine, most people want to get a high level of income guaranteed forever, and they like to get increases without it ever being able to go down in the future?
Well, they do, but they don't know about these types of products. And also people are concerned about inflation right now. And the only way you can manage inflation effectively is to have income that's going to increase over time to offset the impact that inflation is going to really have on your income.
Well, what about when someone says, put your money in the stock market for inflation fighter, and the stock market crashes? What chance do they have of keeping pace with inflation?
Well, forget about that. You're not only not going to keep pace with inflation, your income probably going to go down because you'll be frightened about taking any money out of your portfolio until it goes back up, right?
Definitely, definitely. So when you talk about Leon and Sally, we can help you a lot. So if you're like anybody else, we'll give you a free second opinion. Anybody else out there thinking about it, just give us a call if you have questions. We'll be glad to answer those. Or you can go to our website, and there's a lot of great data there. And you can also contact us or set up an appointment that way.
Yeah.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
It's safe to say that every single person watching has been told, hang in there, ride it out, when the stock market goes crashing down, only to see their portfolios drop by 30, 40, even 50%. They're never told to get out of the stock market, and sometimes they lose more than they ever thought they could. Today on Peak University, Dan and Jim are going to discuss how they manage portfolios.
Thanks, Mark. Jim and I see so many people coming in for a first meeting with us, a second opinion about their money, and they're worried so much about how much they could lose in the stock market because it's happened to them in the past, and then now recently they're seeing a lot of volatility and they're worrying more and more it's going to happen again. So we want to ask a couple questions. The first is, if you're retired or you're close to it, when the stock market's volatile and you see your portfolio suffering large losses, not small little blips, but large losses, and your advisor then tells you to do these things, hang in there, ride it out, stay the course, and don't worry. You've all heard this probably hundreds of times. Hang in there, ride it out, stay the course, and don't worry. We want to know, how does it really make you feel in your gut, in your head and your gut? And what does it mean when they're saying these things? Think about it. What are they really saying when they say these things to you? Well, what they're really saying is, basically, it's okay to lose a lot of money and hopefully you'll recover. Let me say that again. What they're telling you is it's okay that you lose a lot of money and hopefully you'll recover, Jim. What's that really saying?
Well, you know, the viewers have heard this many, many times throughout their career. They've been indoctrinated with this slogan. And that's fine if you're 20 or 30 years old, and maybe 40. That will work out because you have less money, you're making contributions to your retirement plan, and you're not going to retire for 20 or 30 years. But I'm telling you, Dan, if you start to follow these rules when you're 55, 60, 65, or 70, your retirement's going to be completely different than what you ever dreamed about.
Well, it's completely different because when you were 20, 25, 30, or 40, you were accumulating assets for income at retirement time and you had enough time on your side to recover. Now you just don't. It's that simple. Yeah. So we don't want you to hopefully recover. We don't want you to have to recover. You will never hear Jim or I tell you, hang in there, ride it out, stay the course, because to us it makes no sense. We don't do that with our own money. We're not going to advise any of our clients to do that with their money. So we've created, Jim, what we call our 3-bucket approach to investing for retirement security. And it makes it very simple because right now most consumers, most retirees and people planning for retirement right now, they have this diversified portfolio and you have 20, 30, 40, or 50 different stocks or mutual funds, and you're told you have all these different mutual funds or exchange traded funds or stocks because you're diversified. And diversification means you'll have less risk when the market crashes. Well, if you go back to 2022 and look at someone who had what's considered a moderate portfolio of 60% stocks, 40% bond mutual funds, those people still probably lost about 25% because the bonds, in a lot of cases, lost as much money in the stocks. So how can that type of portfolio be considered moderate or conservative? It just isn't, because all the assets acted the same.
That's exactly right, Dan. But the consumer doesn't understand there are ways to construct a portfolio that you don't have to go through that type of losses and that type of stress in retirement.
Exactly. So we look at our 3 buckets. Let's start with bucket number 1. We call it our principal protection and our lifetime income assets. That bucket is a contractually guaranteed insurance product. It's a fixed index annuity with an income rider. And annuities scare people because of the name, but that really is because of variable annuities. Variable annuities have a lot of volatility. You can lose principal, and most have a very high potential fee. What if you had a green bucket that basically had principal protection? It guarantees your assets against all losses. It gives you income guaranteed for as long as you live, regardless of how long you live. It gives you the opportunity to earn a portion of the gains inside of that index. It can give you potential income increases while you're living, with the income increases never going back down, and it can have some very low fees as compared to other assets. That's a great place for some of the money. That's bucket number one. How about bucket number two, liquid assets? That's just bank money. You need to have money in the bank for liquidity, for access, makes it easier to spend. You don't have to worry about it. There's no losses and there's no fees on it. Yeah. Then you have our growth bucket, Jim, and we use a growth bucket. So the index annuity is just part of the portfolio. Then stocks and bond portfolio, etc., that'll be part of our growth side.
Yeah, so on the red bucket down here, we're using low-cost funds. We're using exchange-traded funds from big firms, and we're also using individual stocks. Our system is mechanically run. It's run with momentum, or based on momentum. It's run with algorithms, exactly. We focus on trying to stop large losses in the portfolio by using what is called stop-loss technology every day. So if the market momentum changes negatively through the course of the month, we can stop out. And again, as I mentioned before, this is system-driven. There's no human being making the decision. This is all done mechanically.
When you think about that, isn't that how most people want their money managed these days?
That's what they want, but they're not getting that, Dan. So this is a very tactical approach. It does it with mathematics, science, and data. There's no emotional decisions being made to drive the money.
So maybe explain exactly how it works.
So let's take this example. We have 44 different positions. And you got to imagine, we're not just buying and holding and telling you to stay the course. Every month, on the first day of the month, we're making a decision, or the math is making a decision of what you're going to hold for just the next 30 days. So for example, we're looking at the 20 top stocks on the NASDAQ and the S&P 500 every month. We're looking at 8 inflation-focused ETFs. Those are commodities, for example. It could be lithium, it could be gold, it could be general commodity. These are ETF, big funds. We're looking at 8 equity-focused ETFs. It could be the Dow, the Russell, the NASDAQ, the S&P. And we're looking at 8 fixed income-focused ETFs. These are treasury bonds. These are high dividend-paying bonds at large firms. So the data is being analyzed every day through the course of the month. And on the first day of the month, the algorithm says, okay, do we have any momentum in the marketplace? It selects maybe 8 of those and gets rid of the rest of them, and it does it the following month and the following month, Dan.
So that keeps you in what we consider the 8 funds or stocks with the best momentum and keeps us out of the 36 with the least momentum and growth potential. Now, how about that annuity side, the green bucket side? Let's now look at a married couple age 65, and let's say we put $1 million into the green bucket to generate income for them. Income's guaranteed to be paid to them for as long as they live, and regardless of how long you live, regardless of stock market crashes, and regardless of how much your account earns, you're going to get your income. So let's say you had $1 million and you wanted income immediately, and you can take it immediately in a lot of the plans. You put in $1 million at 65, you can take out $63,000 a year, guaranteed for as long as you both live, which is a 6.3% payout. If you defer for 1 year, not take income, we can then get you $69,000 a year. If you defer for 2 years, $76,000 a year. For 5 years, we can get you almost $100,000 of guaranteed income per year, every year, no matter how long you live. That's almost a 10% payout of your monies. That is an awesome way then to be able to use your assets to create a guaranteed lifetime income stream. And the longer you defer, the more you get. The goal isn't to defer forever. It's to make sure you hit that income you need to be able to maintain the lifestyle for a wonderful retirement. Back to you, Mark.
Thanks, guys. The 3-bucket system used for liquidity, income, and growth seems to make a lot of sense for retirement. I especially like the use of stop losses and guaranteed lifetime income. If this is something you'd like to learn more about, give us a call in the office right now, 916-452-7325.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thank you for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.